We are increasingly seeing economists and other analysts relying on real-time information or data as much as possible in order to gauge where we are in this recovery. Expert Development Canada is doing similar work and has created a new tool to help track the economic progress of the country. Peter Hall is Chief Economist of EDC. He's with us now. Thank you very much for being with us, Peter. And let's start with this so-called high-frequency data that people are talking more and more about and the importance of it. In other words, what led you to want to create this tracker?
Well, there are so many data series, Amanda, that are available on a daily basis. They're being tracked in real time, and none more really than the COVID data themselves. They have become really the leading indicator that has supplanted all other leading indicators of the economy. Why is that? Well, wherever COVID goes, that's where the economy goes. As we all know, if the infection rates spike, the economy goes into shutdown, either partial or complete. And if they come down, well, we open up again and economic activity begins. So this has really shown the way. It is so readily available, updated every 20 minutes, actually. And there are so many other series that we can combine together in an indicator like this that gives us a much more up-to-date sense of where the economy is actually at.
So then let's talk about what it is showing, because it seems as though, as we've seen elsewhere, Peter, there's grounds for optimism in terms of where we've come from the depths of the shutdown. And then we will ask you to extrapolate a little bit about where we think we might go from here. What are we looking at right now?
What the indicator tells us, Amanda, is that from the pre-COVID period peak, we dropped about 45% in terms of overall economic activity, and our indicator bottomed out in late April. That probably means that sometime in mid-May was really where the economy itself bottomed out, because we have some leading index capability inside of this indicator. Well, from that point, from that crevice or the chasm in the economy, we are now down only 19%. Now, that's still, roughly 20% that the economy is missing from what it had before, but we're more than halfway back. And that's a number that's as of July 10th.
One of the numbers that, of course, tells us a lot about what might happen. So it is one of the less, I guess, with the less harder to hang on to numbers. But sentiment drives so much about what we will do and spend and plan for. What does the sentiment data show?
Well, we're using two indices for that. One is your own Bloomberg Nanos Consumer Index, available on a high-frequency basis. And, of course, we're also paying a lot of attention to the Purchasing Managers Indices. That gives us a 6-month lead on what businesses are actually expecting to do in terms of their purchasing activity. Well, that gives a great sense of how it is that a huge chunk of the economy is feeling about actually coughing up the money that they have. We know that they're storing it up right now. Savings rates have really spiked. So it's really important for us to get a handle on sentiment, because when that improves, then we get an unleashing of all of this pent-up spending activity, which is a very, very substantial amount of money in Western Europe, the United States, and here in Canada.
So when we look at, the other number, of course, that matters so deeply to Canadians, it'll factor into sentiment and spending and the like, that employment number. When we look at where we are and the recovery we've seen, give me your thoughts on how we track forward and what you think some of the inputs will be that will shape that one way or another.
Well, when it comes to employment, we've also got high-frequency indicators that are telling us what it is that's going on there. So we have a sort of a newer version of the Help Wanted Index that we've got in there from a supplier. And this gives us very up-to-date information on what hiring intentions are. When you actually place an ad, it's going to be a while before you get a person into place and then start paying them an income. So if we get a jump on that, we get a sense about the more fundamental aspect of spending. This isn't just sentiment. How good do I feel about spending? But this is, oh, I've got my job back, or I've got a new job. Now I really do feel quite anchored in my spending. So this has been an indication, a very robust indication of recovery in the past. And we're very glad to have this indicator embedded in what it is that we're looking at right now. It's so key to get a handle on this, especially as things are changing so quickly right now.
There are some things about this that, of course, make it anomalous to anything else we've seen before. And there's a couple of pieces of that I want to ask you about. One is the financial markets indicator. We know that the state of the stock markets, for better or worse, has a psychological effect on all of us, and it can have a real effect, of course, on your net worth. It may be, though, an asset bubble. It may not be as genuinely driven by underlying economic fundamentals as we would like. So I'm curious for your take on the disconnect we might be seeing there, and whether it matters that we sort of adjust for that.
Well, whatever is happening with respect to the volatility of equity indices at the moment, Amanda, we are still seeing financial markets that are trying to get a jump on where the economy is going. So they did that on the way down. We saw enormous decreases in indices all over the world, including our own TSX. And as the economy started to come back, well, those bets were being placed there on where real activity was going to be. It might be magnified by other things that are going on out there, irrational exuberance and excess of liquidity, quantitative easing actually feeding into that as well. But the general movement itself, we believe, is still a leading indicator of activity. The magnitudes of movement may be exaggerated, but the actual direction of movement is telegraphing something that's happening in the economy. Let's face it, if equity markets think we're in for another tumble, they're going to try and get ahead of that as well. You see a lot of shorting activity going on. We haven't seen that, and so that's what we expect it is telling us about that. That's why we've incorporated it inside of this measure.
All right, Peter, and we will continue to monitor the recovery tracker and have you back to break it down for us as we go forward. We appreciate your time today.
A pleasure.
Peter Hall is chief economist at EDC.